So now we are going to the second type, main type of leverage, which is the financial leverage. So financial leverage results from the use of debt financing, that is the use of debt, bond, debenture, or along the venture capital along with owner's equity in the capital structure. So it measures the impact of debt in a firm's earnings per share and net income. So firms with higher financial leverage will face higher risk due to fixed interest payments. So when we are calculating the degree of financial leverage, we are going to be using the formula. So DFL, that is degree of financial leverage, equals to percentage change in earnings per share divided by the percentage change in profit before interest and tax, right? Or it could be expressed as DFL equals Q into S minus B minus FC divided by Q into S minus B minus FC minus R, where R equals to interest rates. That's interest rate on the debt that was accrued. Interest rates, right? So now there are many different ways the question can be asked a, when we are solving degree of financial leverage. So this is for when it's just a debenture debt or anything. But like when the company has preference shares in its capital structure, now when there is preference shares or when there are preference shares, there are preference shares. The formula will be a bit different, right? Because we have to account for the dividend that is being paid for on the preference shares. So that's DFL equals Q into S minus B minus FC divided by Q into S minus B minus FC minus R minus DP divided by 1 minus T, right? And then DP is the preference shares dividend, preference shares, and C equals tax. Now we are going to be working on illustration question to enhance our understanding, right? So David Limited currently has a sales volume of 50,000 units with a total cost, fixed cost of 300,000 naira. The selling price is 20 naira, variable cost per unit is 10 naira. It has in its capital structure 15% 300,000 debentures and 18% 100,000 preference share capital. If the corporate tax is 40%, calculate DFL at 50,000 units. So this is quite straightforward. So we want to calculate DFL, the DFL based on the question. So as usual, we're going to write out our formula that is relevant to the question and extract our variables. So DFL equals Q into S minus B minus FC divided by Q into S minus B minus FC minus DP over 1 minus T, right? So now we are extracting our variables. As from previous question, Q is 50,000 units, S is 20 naira, V variable cost is 10 naira, the fixed cost is 300,000, right? But then now there is a twist to the question, like we all know. So now we have to calculate our R. We have to calculate our R, we have to calculate our DP, I have to calculate our C. right? So now our from question is the is 15% of 300,000. 15% of 300,000. That's on the is the rate on the debenture, which is giving us 45,000. And then the dividend on preference shares is 18%, right, of 100,000, which will give us 18,000. And then the tax that is being paid is 40%, right? So fix it into the question. I made a mistake in the earlier one. It's supposed to be minus R minus D P minus divided by 1 over T. So to solve the question, since we already have our variables and we've already extracted them, we just put it into the formula. So Q is 50,000 into 20 minus 10 minus 300,000 divided by 50,000, another 50,000 again into 20 minus 10 minus 300,000 minus the R 45,000 minus DP is 18,000 over 1 minus 0.4, right? This will give us 200,000 over 200 over 125,000, which will give us it will give us 1.6. So it shows that a 1% increase in EBIT will increase our EPS, that's earnings per share, by 1.6%.